The potential impact of currencies on international equity investments cannot be overstated.
Whenever you take an exposure in a currency, you're taking risk.
Consider the Japanese equity market returns of 2013. Japanese investors realized gains of 54.6%, while unhedged US-based investors saw a 27% return.
All your alpha in the asset class that you're really concentrated on, that you're really an expert on, can be eroded by currency moves.
Until recently, currencies and international equities were widely considered inseparable. Now, that's no longer the case. Today, investors have the option of actively managing currencies or hedging them out of the equation entirely. On the other hand, by keeping your currency exposure unhedged, you may be able to take advantage of a strengthening foreign currency that boosts your returns. If you don't have a strong point of view on currency one way or another, you can work with an active manager to help you manage your currency positions.
Currencies can move quite a lot, 10, 20, 30% more sometimes, and quite fast as well.
Currencies are dependent on flows in other asset classes, and you always have to be aware of these correlations. If you have got a clear opinion that the currency is vulnerable to a devaluation, or if we have got a high conviction for a currency appreciation, we leave the currency risk open or even enhance the strategy.
If you're ignoring the currency markets, you're leaving alpha on the table.
Currencies are widely perceived to have a long-term expected return of zero. However, they tend to increase portfolio volatility. Consider the MSCI EAFE index since 1973. Over rolling 5-year periods, currencies have increased volatility 91% of the time. Aside from increasing volatility, many investors believe currencies increase portfolio diversification, but that's not necessarily true. Typically, it's stocks, not currency, that drive diversification.
For investors that are purely focused on the investment and do not want to deal with the currency aspect at all, we systematically hedge their portfolios.
Today, Deutsche Asset Management offers 25 currency-hedged, exchange-traded funds to help investors gain exposure to international equities while avoiding the unintended impact of foreign exchange.
We have dedicated foreign exchange traders, and we can service our portfolios globally and 24 hours a day.
Managing currencies is a dedicated approach across the global platform of Deutsche Bank. The final outcome is a consistent view across all the asset classes as a guidance for the entire global platform.
At Deutsche Asset Management, we have the tools, strategies, and solutions to help investors manage the impact of currency with the goal of meeting their individual investment objectives.